As oil stays above $100 a barrel, bond yields and inflation expectations around the world are rising as well. Few advanced economies are feeling the pain more than Japan, and fewer still are as poorly equipped to handle it. Japan faces a unique oil bond FX triple whammy due to the Iran war. We decode that and more in this next report. Take a look.
The global sovereign bond sell-off has steadily gathered pace since the war in Iran began over 2 months ago. Last week, Britain's 10-year gilt yield closed above 5% for the first time since the 2008 financial crisis. The 10-year German bond yield touched its highest level since 2011, and the 10-year Japanese government bond yield matched its highest close since 1997. Japan's exposure and vulnerability to the global energy shock are unique among the G7 group of developed nations. It relies on West Asia for around 95% of its oil supplies, with around 70% coming via the Strait of Hormuz. The Bank of Japan has been forced into a wait-and-see mode as it assesses which of the two risks from the current crisis is greater, a growth hit or an inflation spike. Policymakers in other countries also face stagflationary pressures. But the challenge facing Japan is exacerbated by the country's financial market backdrop. The 10-year JGB yield is the highest in nearly 30 years, yet the yen is near a 40-year low against the dollar. The Ministry of Finance is still warning that it stands ready to intervene in the market at any time. On a real effective exchange rate basis, the yen has never been weaker. This complicates the Bank of Japan's task, to put it mildly. The BOJ's policy meeting last week captured that dilemma perfectly. Interest rates were kept on hold at 0.75% as expected, but the 6-3 vote marked the biggest number of dissents in a decade. Officials halved their GDP growth forecast for this fiscal year to 0.5% and raised their core inflation outlook by almost a full percentage point to 2.8%. The worry and frustration for officials will be that the yen hasn't gotten the memo. To some extent, it's a scenario that has already begun to tentatively play out. So far though, investors appear relatively relaxed. The Nikkei is up 20% this year, hitting an all-time high. This has somewhat helped ease financial conditions to near their loosest level in 35 years. However, the risk is that a negative doom loop could take hold, where high oil prices and a low yen stoke inflation. That will push bond yields up further, but the exchange rate stays under pressure, causing stagflationary forces to intensify. Business Bureau, WION World is One.